Well, good morning and welcome to the Spheria webinar. My name is Mark Cormack from Pinnacle Investment. Pinnacle are equity partners and work alongside Spheria to distribute Spheria's small, microcap and opportunities funds to the Australian financial advisory marketplace. Today I'm delighted to be joined by the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker, who are going to highlight some of the insights from reporting season. They'll also outline some of the opportunities and traps and where to for here. There continues to be a huge amount of money moving around in the small and microcap part of the market, and this has resulted in some stocks being washed out for no reason, while others continue to trade on .com-like valuations. The Spheria team will discuss this and take you through some businesses that are delivering great cash flow with strong balance sheets at decent valuations. Establishing Spheria's small and microcap funds, the team has delivered a 10% per annum return in line with the benchmark, but it's important to note the team has taken much less risk than the benchmark in delivering those returns. And in addition, the Spheria Opportunities Fund, which is a mid-cap Australian opportunities fund, has delivered 12% per annum return since its inception in 2016, and it is recommended by Zenith Research. In addition to the Spheria managed funds, Spheria also manages the Spheria Emerging Companies Listed Investment Company, which is another way clients can access Spheria's investment capabilities via direct equity listed investment company, and the ticker code for that is SEC. Before we kick off, just a couple of quick housekeeping items. Today's presentation should last around 15 minutes, and that'll be followed by Q&A. And all attendees have the opportunity to ask questions via the questions box on your screen. So without further ado, I'll hand you over to Spheria's portfolio managers, Marcus Burns and Matthew Booker, for today's presentation. Thanks, gents.
Thanks, Mark. Hi, it's Marcus Burns here. Just kicking off the webinar. So on slide 2, we've shown this chart before, but we thought we'd reissue the chart and kind of explain some of the thinking we've seen in the small cap space. To Mark's point, we've seen a continued re-rating of very high PE stocks over the last 12 to 18 months. We've dubbed this slide, humans and machines, because we feel it's very apt. Humans or people who are doing fundamental valuation work are finding some of these valuations very hard to understand. But a lot of the money we've seen recently flow between managers in small caps has flown towards passive investors who basically buy based on index weight, or to quant funds that kind of use technical or short-term momentum issues to kind of drive their purchasing investment decisions. Both of which have kind of seen an upward rating of stocks that have been fairly highly rated and pushed them to levels that we haven't seen for a very long period of time, probably since the .com boom 15, 20 years ago. And just to illustrate that point, we went back and looked at the quintiles. We divided the small cap index into buckets of 20% of the PE ratios of all the companies, and just tracked how those PE ratios expanded over the next 12 months. And you can see the red line there, which is the most expensive PE ratio going back a year, has seen a material re-rating in the last 12 months, just indicating that massive dispersion we've seen between the high-rated stocks and the more lowly rated stocks. And there are stocks in there that many stocks there that don't make any money, or cash flow, but have one thing in common, which is a very high growth rate on the revenue line. So the market appears to be paying almost any price for high growth revenue companies and kind of ignoring fundamental value drivers like free cash flow and balance sheets and earnings multiples. And we think that's incredibly unjustified, and we're finding a lot of interesting opportunities in the stuff that's been left behind.
That's right. The positive spin about this is that about 80% of the index has been left behind. So there's significant opportunity in that space. We're finding very fertile ground, good valuations, good businesses, some with assets that just can't be replicated. And these companies, for whatever reason, are boring. There's no interest in them, but that's where we think we can make a lot of money. And in the future, these companies that are currently seen as boring or uninteresting are the ones that could turn into the ones that make you a lot of money. Just moving on to slide 3, we've shown this chart before, and Marcus was just looking at updated figures for this, and the WACs, which is WiseTech, Afterpay, Altium, Appen, and Xero. They were $30 billion when we put this chart together. Now they're up to $36 billion. So you've seen a significant increase in that period. I suspect the earnings of those companies haven't increased by that much. So again, it's pure re-rate which is driving that WACC sector, and it's just weight of money. And at some point, weight of money does get exhausted, and you will see that bubble burst at some point. And we also show on this slide just a basket of companies we own, and you can see that for a similar amount of earnings, you're paying a lot less for the companies we own. Now, in the past month or two, we've actually starting to see a re-rate. So we saw some good results from these companies that we own. You've seen significant interest come back into these names, and you've seen some outperformance in that basket of companies. So we think the prospects for our basket look a lot better than the WACs at the moment.
I agree with that, Matt. And on slide 4, this is a chart we've highlighted previously, but it's actually interesting that we've updated the chart, and so we highlight the disparity here between the smaller companies, those stocks which are in the small companies index, and the microcap stocks which are beneath that and are in the emerging companies index. And that those over a long period of time, those two indices have tracked broadly in line. They do have little gaps in relative performance over shorter periods of time, but over a medium term, those two indices tend to kind of trade up. And we noted that with that flow of funds towards the upper end of the small cap space, driven by, as I said, passive and quant fund investing, we saw a re-rate of the small companies versus the microcaps. Microcaps are probably also a little more economically sensitive, and with the downturn in the economy we saw going back 6-12 months, they probably got sold off a bit on that as well. So a couple of factors drove that disparity in relative ratings, and we did argue going back that we thought there was quite a lot of opportunity to buy into microcaps. Indeed, we switched the small cap fund a little more into microcap stocks, not dramatically, but we did increase the weight, cycle out of some of the stronger performers at the top end of that space. And the gap hasn't been closed. So since January this year, the gap was 12-13% between the two indices, and that's now down to about 5 or 6%. So there's been quite a strong rally at the bottom end, and we'll talk about this in a second. But some of the themes we've seen driving that are really, obviously, with the election out of the way, there's some confidence coming back into the economy. I think interest rates have dropped, so some of the more cyclical sectors have picked up, which has closed that gap from micros. And then we're seeing a bit more corporate activity drift down into microcap space. So we've seen GBST, for example, is one stock we own the funds, has received multiple bids. We think there's quite a lot of interest in the microcap space from a PE and takeover perspective at the moment, given the relative valuations are still very appealing. So yeah, that gap is closed, but we probably would argue that gap will continue to close over the next 12 months or so.
And just moving on to slide 5, just looking at the largest movements last month in the small mid-cap space in terms of share price and dividends. And it gives you an idea of how reporting season was, I guess. So we got the top 10 and the bottom 10 price movers last month. You can see the top 10 was led by BWX, which owns the Sukin brand. And what's happened there is that there's a new CEO in there, David Fenlon, who's come out of Blackmores. He's got a very good track record. I think he's pretty much kitchen sinked the result there, and the prospects are definitely improving for that business under David's watch. However, you've seen a significant re-rate in that company, and what happened is it did get moderately cheap. We bought a position for the first time in a while at the bottom, and we saw a big rebound during the month as the company reported, and David got people excited. Also, there were a lot of shorts on the company, so hedge funds were very short the name, and you saw a lot of covering. So I think it's gone from moderately cheap to very expensive pretty quickly. And we've actually tipped that position out because we think it's a bit overvalued at the moment, but we'll keep it on the watch list. In terms of other dynamics during the reporting season, we saw ERM Power was taken over during the month, and so that's been a bit of a disruptor in the energy space where they've been signing up a lot of SME customers in the market. We've never owned that company. We just have some issues with the cash flow and the sustainability of that model. But you saw Shell basically take that business out. So Shell, which is a global company, came in and bought that out. They're looking to diversify their business away from old fossil fuels towards more alternative energies. And then you see a smattering of gold companies did well. So you saw the tail end of that rally in gold in the Small Ordinaries Index. So you see Dacian, Ramelius, Westgold Resources. So you saw that tail end continue to push up. Obviously, you've seen that gold sector sell off this month with the gold price rebasing a bit. And then on the losers for the month, we saw some different trends within that side of the market. So you saw Boo Media, which has been a very popular company in the media space because it owns a lot of outdoor signage, which has been, I suppose, seen as a structural trend that the market is shifting towards more outdoor media. You've seen that company re-rate aggressively in the past few years after IPOing. It did come out with a significant profit warning. So you're seeing some cyclical trends against it and potentially some structural trends. We think the business might be, or that part of the sector might be plateauing a bit in terms of the share it's taking. You've also seen Bellamy's retrace a bit. So Bellamy's has had a fairly golden run out of a disaster a couple of years ago. and you've seen that retrace a bit. They're struggling to sell their product into China. The distribution into China is changing. The Daigou market here is drying up, and you need to go direct into China. And they've had a few shortcomings in terms of the product they've got in that market in terms of registrations.
Yeah, and it's probably worth noting that both Bellamy's and A2, which had a pretty poor result as well, during their results season, have had to increase their marketing spend. So both had an incredible free kick from that sort of initial rush into China with Australian brands, that clean green image. But both haven't spent a great deal of money on advertising. It looks like that trend is going to change, both flagging an increase in marketing spend, which obviously hits margins.
And then Monash IVF is obviously an IVF business, but they had a cluster of doctors which have spun out of the group. And that's where we do question these doctor models. The doctors have an enormous power versus the clinic, and they can leave and can actually take a lot of business out of these groups. So that's the risk with a doctor model. The other risk is that they renegotiate the gate, effectively how much, what percentage they take of the revenue. So there's a lot of risk with these IVF type operations, and it's not something that we own. The one at the bottom of the list is Speedcast. Speedcast is basically a telecommunications business. It buys long and sells short, and the risk with that is there's a lot of competition in that space, and there has been a downturn in demand. So selling short, they're getting lower prices, and they're seeing basically a shortfall relative to what they're paying for that long-dated spectrum.
They're also very highly geared as well, to Matt's point. So, we've got a big focus on balance sheets and cash generation. Speedcast does generate cash flow, but the problem is it's geared up a lot to buy businesses as it tries to expand into adjacent markets. And what it does, it sells signal basically from satellite signal to oil rigs and ocean lines, etc. But as Matt said, it buys long-dated contracts and then tries to sell short-dated contracts to its customers. But unfortunately, there's a lot of pricing pressure on those contracts when they come up to be renegotiated, which hits earnings and puts margin pressure on. That combined with a very big balance sheet liability doesn't actually help the business, so it's been hit pretty hard. Amaysim struggled because it's had to also reinvest a lot of money into marketing and advertising, and that telco space remains very competitive for mobile handsets.
Just moving on to the outlook on slide 6. So we think small cap and microcap value is the most compelling it's been since the GFC. We do look at the valuations across the spectrum, and we've seen a lot of fund managers in our space actually exit the market, and that's created huge opportunity for the managers that are left. I think the active managers will make a lot of money going forward. It's just a matter of time on that front. We are concerned about valuations, especially in the tech sector and some of the other sectors that have floated up with this monetary stimulus from the central banks. Property and the gold sector have benefited. We think there's bubble territory in tech, gold, and property trusts, and probably other parts of the market as well. But what is left behind is compelling, and that's where we see the opportunity set. M&A continues. Obviously, we saw that with ERM Power during the last month or so. We've seen it with GBST. There's other companies, we see in our portfolio where they're quite strategic, and we think we're going to be the beneficiaries of takeovers. We're not directly positioning for that, but we do own companies that generate good cash flow and are well positioned in the markets they operate, and for whatever reason, they're just out of favour at the moment. The economy has been weak. There has been a housing slowdown. You've seen that in multi-res and detached housing. But the government is throwing a lot of stimulus at the housing market. The RBA has obviously cut rates and relaxed lending standards. You're seeing housing loan approvals go up. You're seeing a lot of investor demand for housing come through. We think that will buoy the market going forward, the housing market, and we think there's a cyclical upturn coming there again. The flip side is infrastructure has been winding down. We're not sure if it's an air pocket or if it's a bit more cyclical in nature. So we'll see what happens on the infrastructure front, but there is definitely a slowdown. We've seen quite a few companies in the past few weeks talk about it. We had one in yesterday who was talking about the infrastructure slowdown, and that has affected some of the building materials companies that are exposed to that space. As I said, the monetary stimulus will drive that cyclical recovery. Also on the West Coast, we think that mining capex will pick up. We see quite a few mining service companies. Monadelphous is one that's very exposed to that trend.
Yeah, I think that's right. Like the mid-level and junior guys junior guys are finding it hard to raise capital at the moment, to Matt's point, but there's quite a few projects that are coming through But for the first time in a while, it had quite attractive economics, I'd say. Cost base is now lower in Australia, given the Australian dollar is down at 68 cents versus the US. So a lot of those sort of natural balancing factors that actually stimulate that kind of part of the economy actually working very well. And so, yeah, and to Matt's point, many of the larger mining companies, BHP, Rio, Fortescue, having to refresh and actually extend some of their iron ore mines, which is creating a lot of opportunity for Monadelphous and a few other quality mining service companies. So there's some pockets of the economy that are showing good pickup and quite good growth. And I think, as Matt said, we should see reflation in some of the housing-related sectors. Some of the retail stocks have been washed out, and obviously media, which looks incredibly cheap now, Matt.
Yeah, media is definitely cheap. I think there'll be some strategic moves in that sector. We think we're well positioned from a valuation perspective and from a strategic perspective. So that'll be interesting.
There's been a positive mindset there with management changes. I think the old media days are starting to look very dated, and I think people are getting front foot on terms of cost cutting, generating cash flow, and thinking realistically about their businesses and whether they need to actually combine to squeeze further costs out, which should be a positive, I think.
I think there'll be an evening of the playing field in media. Currently, a lot of the social media have an advantage in terms of they don't need to produce content here. A lot of the traditional media is hamstrung by having to produce content. There's also some legacy rules around ownership here, which we think you'll see probably eliminated in the next 6 to 12 months. I think the government's listening to all parties. I think you're going to see mergers in regional media. I think that's obviously on the agenda. The government understands that there's pressures out there and that scale is important, and so there will be, I think, a lot of consolidation in that market. But we're pretty excited about the outlook for our portfolio. We've seen a significant turn, particularly the last couple of days, but also last month in that microcap sector last month. But also there's been a big shift to value in the last couple of days from growth. And some of these companies we're buying are just that cheap. Mathematically, it's hard for them to get cheaper. You'd have to think that there will be a significant re-rating in these companies. And I think Marcus and I have discussed it at length. I think there's going to be significant M&A in our space because you can fund things pretty cheaply with debt and equity these days, and you can get a pretty quick payback on some of these assets.
Fantastic. Look, thanks, guys, and always great to get your insights on the opportunities within the mid, small, and micro-cap market. Just a reminder that all attendees do have the opportunity to ask questions via the chat box at the bottom of your screen. Look, while we wait for a few more questions to come in, I just thought I'd outline how Spheri is being used in portfolios and just some advisor feedback. The Spheri investment approach really lends itself to investing in businesses that generate strong cash flows, low debt, with strong balance sheets. And a lot of our investors say that Spheri funds really pass that sleep at night approach. Sleep at night test in terms of their approach to investing really sits in that core part of their small and micro-cap part of the portfolio. Spheri also have a very open mind with respect to leaving no stone unturned, but they also identify businesses either both growth or value. So they're very much a style neutral manager, so they're not sitting in one bucket or the other. And finally, you're investing with a highly experienced team, a team with capacity, a team that's got a strong track record of delivering outperformance and taking much less risk than the market. So hopefully that gives you some context in terms of how Spheri fits in portfolios. We do have a couple of questions, so we kick off with those. With the valuation so low, you mentioned takeovers in the likes of GBST. Could we see that with a company like Class?
Thanks, Marcus. Look, it's not just Class. There's a number of companies in our portfolio with similar kind of characteristics. I mean, Class has nearly $20 million in cash. It's a SaaS business with over $40 million of revenue. The retention rate is over 99%, so it's an annuity stream-like business. There's some changes coming through there in terms of strategic direction. I think they're going to try and increase price on the core products, but they're also moving they're spending money to move into adjacencies, and the product can be moved into adjacencies, which are big verticals. The family trust space, etc., is a huge potential market for Class. So look, obviously it's going to be attractive to acquirers given the current multiple it's trading on and the growth prospects and the locked-in revenue and earnings that it has. But there's a number of companies across the portfolio which we think are compelling from from a number of perspectives. So don't want to get just focus on that one.
Guys, Botanics Pharma, do you guys have any view on that stock? It's I'm not sure if you've covered it.
No, it's not one we've looked at. One of the team members probably looked at it, but not one that Marcus and I have looked at.
Right. Okay. Another stock-specific question. McMahon earnings outlook. A client says here looks pretty good. They're paying a small dividend again. We'll probably renegotiate the Telfer contract. Telfer, sorry. What's your view there?
Yeah, the Telfer contract's been a problem for the company for some time. They're trying to renegotiate it with Newcrest, but it is a life of mine contract, and there are some nuances around it, so it's not as easy as it sounds. And also, they're facing some cash burn on the Indonesian contract at the moment. So there's definitely some issues. They've had some ructions on the board. Some good people have left the board that we had a lot of faith in, and at the moment, we don't own the company because we think there's some significant risk in the business, and I think the directors that left probably left for a reason.
Okay. Another stock that you guys have had in the past is a question here, Mortgage Choice. Great cash flow conversions. Do you see any risk with Mortgage Choice post-Hayne report?
Look, that's a good question. We see dramatically lower risk, obviously, post the Hayne Royal Commission, because, as you know, Hayne came out and recommended they shut down mortgage broking, bizarrely, frankly, when it actually had material competition between the banks. So both political parties, as you know, came out after that and said that they would not support that recommendation. So it's pretty clear that mortgage broking has survived that scrutiny. We have a view that Mortgage Choice is one of the better run businesses in the space. It has a whole bunch of things that we think mean it's got better compliance than many of the competitors. It has had a bit of a rebasing of the earnings by increasing the payout to some of the franchisees, which again is a positive for the duration of the business. And the stock's still trading very low multiples. And as Matt said, I think with rates coming down and being cut, and with the relaxation of some of the APRA rules, it's only logical there'd be a pickup at some stage in the mortgage applications. Banks are still being fairly slow to process these things, but it's natural there'd be some sort of stimulus there and a response. So it's trading on very low multiples for a business that's got a tremendous recurring revenue stream in the form of its back book, and it's very sensitive or likely to see a pickup in the front book at some stage. And yet it's trading on about sort of 10, 11 times earnings, got a net cash balance sheet. It'll pay a stonking dividend yield going forward, probably 7 to 8% fully franked. So we think it's very, very well positioned, frankly, to benefit in multiple ways, and there's not much in the share price.
Excellent. Okay. Another stock-specific question. What valuation did Tech One get up to in the dot-com bubble, and is it anywhere near that now?
No. So it got up to 80 times, Matt?
80 times.
80 or 90 times 4 PE, I think. Check those numbers, basically, but that's a rough recollection. Trading now probably on about half that multiple, so it is fully priced, we'd argue, for a fantastically well-run business. We find it's a bit of a hedge for us in the space. It got cheap 18 months ago on any kind of measure. Now it's at levels that we think are reasonably fully priced. We like it because it's extremely well run. It will accrete value through time. Back to Mac's point with the Class, it's got a 99% retention rate of its client base, so it doesn't lose its clients for very long periods of time. And it's shifting towards a SaaS model, which is very attractive in terms of long-term economics in that business. Cash flow improves. It becomes more regular, more easy to forecast. And there's an embedded price increase, actually, in the way they price those contracts. So all that means it's got great tailwinds. But you're paying a pretty full multiple for it currently. We just think
UK market.
Yeah, and it's got and to Matt's point, even though it's not by no means mature in Australia, it's got very good opportunity to expand into the UK, where it's break even this year and likely to make money going forward. So yeah, lots of reasons to like it. Valuation's a little stretched.
Okay. Lovely stock-specific questions. Vita Group, could it have some upsides because of 5G rollout, and does it come into any consideration in terms of your future valuations?
Look, 5G is going to be positive for Vita Group. We had them in a couple of days ago, and they were just talking about the actual telecommunications business that they have. It's actually, I think it's in a much better position than we thought. Some of the supply arrangements have improved. So there's a new handset called Oppo, which is an Indian manufacturer. It's a very good handset, and it is a $500 to $1,000 handset, but it's taking a lot of share. and the terms they have with that supplier are very good. So it's actually more lucrative for them to sell an Oppo than to sell an Apple iPhone for $1,500. And so it's a part of the market they really weren't, they're probably losing that customer before, and so they've gained a part of the market, but also anyone who wants to trade down from an Apple iPhone to an Oppo, they're getting a higher gross profit on the Oppo phone than they are on the iPhone. So we think the dynamics in terms of supply arrangements is improving. The other one is Huawei has entered the market as well, and those arrangements are very positive for Vita Group. So the actual core telco business is, I think, well positioned. It is a bit of a gravy train for them. They run it really well. They continue to make a lot of money out of it. They're great at cross-selling their own product into the customer. So they've got their own product called Sprout. And Sprout a couple of years ago had, say, $20 million of revenue. It's now up to $80 million of revenue. And so they're selling a lot more Sprout internally to customers, but also they've got wholesale arrangements with other Telstra shop operators and other operators in the telco space. So that Sprout brand is very lucrative for them. The gross margins on Sprout would be anywhere from 60 to 70%. So that business would be, making, probably around $40, $50 million in terms of gross profit for the group. So it's a huge part of the business. Now, the other market that they've shifted into is the cosmetic market in terms of cosmetic procedures. They call it skin health and well-being. But they've moved into that market and they've got a fantastic strategy. So they're putting capital into that market. It's a growth market. It's very fragmented. They have some software which they are rolling out. It's good software. It's a big market in terms of potentially just rolling their software out. But they are opening up clinics in that space under the Artisan brand. And, there's all sorts of compliance over the top and an attractive clinic type model that they're rolling out at the moment. And they're attracting a lot of good doctors, nurses, etc. to that business. And we think there's a significant growth runway in that business.
Right. Okay, guys. Question on notice here, you may not have the data, but do you know what the average EPS growth is for the companies in the small and microcap fund?
Oh, that's a good question. We could have a guesstimate, but we could get the data. We have the database that measures that. My guess would be somewhere between 7 to 10%. Matt, what do you think? Could be a bit lower, but
Yeah, it's hard to know off the top of our head.
Yeah. Look, we'll come back to you on that one. And then final question: capacity for smalls and micros in terms of capacity available.
Yeah, it looks. The microcap fund, there's a bit of capacity that's opened up there. Small cap still has significant retail capacity. The opportunities fund, which isn't on a lot of the platforms, is also open for business. But so there's still retail capacity across all three strategies. In terms of institutional capacity, we're pretty much done on that front now. Yeah, we're pretty much closed.
Yeah, and I think just on that point, I mean, we recognise the importance of having a funding open for retail advisors, both in terms of receiving flows and managing distribution, etc. So our strategy when we get close to capacity will be to soft close rather than hard close, so we can manage that the amount of money we run, but also work with current advisors who support the company or the funds. Yeah, so that's the strategy. So there's a bit of capacity there, but we will carefully manage that.
And the good thing about how we manage money is we tend to be buying stuff that perhaps is not doing that well. And usually there's plenty of liquidity around. And then those companies that aren't doing well at some point they tend to do well, and that's when we're selling them, so they become expensive. So we find that capacity is not a real issue for us in terms of liquidity is not a real issue for us. We're never going to be running $3 or $4 billion like some of our big competitors in the small mid-cap space. We're just over $1 billion now, and that's probably where we're going to see it be for the foreseeable future.
Fantastic. Look, that's all we have time for today. Currently, the Spheria small and micro-cap funds are positively rated by Lonsec and Zenith, and they're available on most wrap platforms. If you're interested in allocating to the Spheria Opportunities Fund, we'd certainly love to hear from you in relation to providing access on your preferred platform. And just remember that Spheria Opportunities Fund is also recommended by Zenith. We will be making the webinar available on the Spheria Investment website, www.spheria.com.au. We'd like to thank you for your participation today. Some great questions. We'd like to look forward to seeing with you at our next webinar, luncheon, or at our next advisor meeting in your office. Thank you very much and have a great day.
Thank you. Please stand by.